Hey guys, welcome to the Everyday Investor, the hottest investment show in the world. That's right, I said it. I don't care who knows it. This show is designed to help us all grow our money. You see, often the challenge is we take our precious time. We only have 168 hours in a week. We take that time, we go to work, and if you go to work, you are blessed. It's great to have a job. Don't let anyone tell you that it's not great to have a job. But we go take our time, we go to work, we get a paycheck in order to eat. We take our time, we go to work, we make money so we can provide. Imagine a life where money could make you money, so you have extra time to spend it on what you want. You spend that time with family, friends, engage in a purpose greater than yourself perhaps. That is what this show is all about. Remember, when anyone offers you any type of investment opportunity, you always want to ask 4 questions to start. Number 1, what's the ROI? What's the return on investment? 2, when do I get that return along with the money that I put in? 3, what is the minimum investment amount needed? And 4, you look them right in the eyes and then you ask them, what is the downside? What is the risk? If they can't answer that, turn around and run real fast. Super excited about this show. We're going to be talking to my friend Andrew Brennan, author, investor, does a lot of investing, but he also partners with people like you and I. Don't go anywhere. We'll be right back.
Is multifamily or commercial multifamily mortgages start at usually 5 units and up, right? So a lot of people might be talking about duplexes or fourplexes as a multifamily, but that's still in the residential world in the mortgage industry.
Hey everyone, Lee here at Wise Construction, bringing you this week's tips, and I'd like to talk about insulation. So insulating your house is one of the key important parts of keeping your home warm and cold, depending on what season it is. What we like to do is we like to use a foam spray. The reason why we use a foam spray is it's a way better product. It gives you a equal R value, and it's just as expensive as doing your batt insulation as well as your rigid board insulation, and you get a far better return on it. You can also do your energy audits as well, but you must make sure when you're doing your audits, you do an audit before you start as well as after. If you have any questions, feel free to reach out to me and be happy to explain to you and talk to you further about it.
The mortgage world has changed. Has your advice? Are you looking for a modern approach to your mortgage planning process? Advice tailored to your unique, ever-changing circumstances? Whether you're upsizing, downsizing, purchasing, or refinancing, the Kyle Ford Mortgage team works with individuals and companies to custom tailor the right mortgage product for you. Working with a wide selection of lenders, we're here to serve our clients and help them achieve their real estate and retirement goals. Contact the Kyle Ford Mortgage team today, Canada's mortgage choice.
Hey guys, Omar Khan here from Theta Trading. I wanted to talk to you today about the benefits of using options to buy stocks you'd be buying anyways. Now typically, if you want to buy a stock, let's say it's stock X, Y, and Z, and you say it's $10 a share. Well, the choice that you have currently is you can buy it for $10 a share. But imagine if you could simply agree to buy it, let's say for $9.50 a share, and someone will pay you 50 cents for doing that, let's say 5%. If you know that you want to buy the stock, isn't that a great deal? And that's what we do day in and day out here at Theta. We get paid a lot of money just for agreeing to buy stocks that we would buy anyways, but at a discount. So if you want to learn how to buy your stocks at a discount and get paid for it, please feel free to reach out. Otherwise, we'll see you guys next week. Take care.
Hey, it's Rav. Welcome back to Everyday Investor. We're talking to my friend Andrew Brennan about how we can make money partnering with the Palm Tree outfit and make significant returns. Andrew, thank you so much for being on the show with me.
My pleasure.
Yeah, I remember
Thank you for having me.
I was sitting on a beach somewhere down south and somebody gave me a very thick orange book. I don't even know what it was called, but it was really well written, and it came together. It was kind of, like a story within a story, and it really talked about the BRRRR, if you will, buy, rent, or buy, renovate, rent, refinance. Now people say repeat, and you and a couple of your friends, you were the author on that. What was that book called?
The ultimate wealth strategy.
The ultimate wealth strategy. Well, you're still doing that, but you're doing it on a bigger scale. Tell me a little bit about your portfolio. I'm born and raised in Kingston, Ontario. I left there when I was 18, 19 years old. Really excited that a lot, if not most of your investments are in Kingston. But talk a little bit about your portfolio and your story. And I think you still even have a single dwelling. Now you're up to 40, 50 units per building, but you even still have your single dwelling, which is kind of cool. Tell me a little bit about your story.
Yeah. So the book actually relates well to people in the, wanted to say do the 2 to 4 unit range. And that's where I started. So I did buy a bunch of single families, bought them, renovated them by putting in basement apartments. And we would then go back to the bank and refinance to move the money on to other properties. And I still have several of those properties. Currently, I sit with over 100 different properties. And I ended up having logistics problems with so many smaller properties. So I had to transition from the strategy, which is great in the book. But now we try and do it on a little bit bigger scale. And we don't necessarily do so much work, physical work, that we dictate or talk about in the book. We often now do trying to drive values up by doing cash for keys on the larger buildings, right? So same philosophy, but a lot easier just to pay tenants to leave and turn their rents over to make higher dollar amounts. But it's basically the same concept, and it works really well, right? Buy it, turn it over, get velocity on your money, and repeat.
Yeah, no, I love it. And when you say 100 properties, that's not 100 doors.
No.
That's 100 dwellings you have.
Yeah. At one point, I was around 125 separate dwellings, and it just becomes too much of a logistics issue to have so many roofs, so many furnaces. So been transitioning out from some of the smaller stuff. And the other thing is, today's market, it's hard to get so many mortgages, even with raising funds from investors and stuff like that. I've done very well. I've had to recycle some of my own money into other projects, so it's much easier. There's no real limit on how many commercial mortgages you can get on like a 20-plex.
Yeah.
Right. So it makes it a lot easier.
Yeah, it's always been interesting to me. I mean, when my buddies in the States, the more properties that they have, the more mortgages they get. But in Canada, the more, I'm talking residential, the more properties, investment properties you have, the more the squeeze on you.
Correct.
I've never really understood it, but is there any reason to that, Andrew, or is it just because our great country is very conservative?
I think it's probably because we're too conservative.
Yeah. Okay.
Right. I mean, to me, there's safety in numbers. So someone who has, say, 3 or 4 duplexes is a lot more at risk than someone who has, say, 500-600 units.
Yeah.
Right.
If
you have 1 or 2 tenants that are bad apples at 500 or 600, you don't even notice that missing rent. You have 1 tenant out of, say, 6 or 8 doors, it can be a problem.
Yeah. So right now, and what's the difference? Because there's terminology. Is it the same thing, Andrew? Multifamily, multi-unit, apartment building. Is it all the same word? I mean, break that down again. I like to make this a very, I barely finished high school, so I don't want to assume that all the viewers are incredibly sophisticated with all that big language. What's the difference between multifamily, multi-unit, apartment building? Like, is it the same thing?
They're pretty much the same thing. The difference would be, in the eyes of the bank usually, is multifamily or commercial multifamily mortgages start at usually 5 units and up. Right. Okay. So a lot of people might be talking about duplexes or fourplexes as a multifamily, but that's still in the residential world in the mortgage industry. Once you get over, there are a couple of banks that'll go a little bit over 5, but definitely once you get over 6 or 8, you're in the apartment building, multifamily space.
Okay. Yeah, because you've got a dwelling that has almost 50 units in it. So, I mean, I call that an apartment building, no?
Yeah, that would be I don't think there's a set number to call it an apartment building. I would say maybe 10 or 12, and then you have a small apartment building.
Okay. So now you are predominantly, if not exclusively, buying apartment buildings.
Correct.
And then what you're doing, and you're buying undermanaged, run-down apartment buildings.
No, not actually. We're buying low rents. So we're buying buildings with, say a rent roll might be 70 or even 60% of market.
Oh.
And you might have a great building that, as far as quality and well managed, but if tenants don't leave, you can only raise rent so much. So naturally they fall behind in an environment where there's rent control.
Got it.
Right. And a lot of people don't relate the building value to the net operating income and the cap rate and figure I should pay some of these tenants to leave.
Yeah.
So I can take my rent up, hence take my building value up.
Yeah. And I just want to park there for a second. So what you're saying is, because a lot of people don't know this, that you're taking your income from the building, which is really the rents. I mean, there's other things that you could throw a car wash in there if you wanted to, but whatever. You're taking money, the rents, that's your income, and then you're dividing that by what's called a cap rate, capitalization rate, and that rate is general to the area or whatever the case may be. But what that spits out, that's what increases the value of the building significantly. So we take our net operating income, we don't include mortgages or anything like that, but we take our income, we divide it by the rates, and that's what's going to explode the value of that building. And then you may refinance that, pay out some investors, just enjoy. So let me back up for a second. How do we increase the income? You already said raise the rents. But in Ontario, we have rent control without, divulging all of your secret sauce, because obviously you have systems in place that are ethical, legal. You've been doing this for a long time. Like I say, you have a great reputation. How are you increasing the rents?
Basically, it's paying them to leave. So, there's a couple strategies. You can actually negotiate something with a tenant to say stay and pay a higher rent. So we've sent tenants to, say, a hotel for 2 weeks, fixed up their unit, gave them some cash. They come back with a new lease, close or at market rent. We've traded something for value for that higher rent, right? They might, for example, like the tenants, the other tenants in the building, or they might like the neighborhood because it's convenient for work, but they would appreciate a newer unit, but just don't want to transition to another location.
You know what I love about this, Andrew? God only made a few perfect heads in the world. The rest he covered with hair. Now, what you're saying to me, you're speaking my language. You're saying there's nothing emotional about this. This is all about numbers.
Correct.
So you are willing to pay Rav, who lives at 123 Princess Street in Kingston, Ontario. You are willing to pay me money to go to a hotel, take care of me, so on and so forth. I come back, I got new paint, new floors, maybe countertop, an appliance or two, whatever. But the numbers still make sense. You're going to charge me $200 more a month or whatever the case is.
Yeah.
The numbers still make sense. Or you're going to say, Rav, I tell you what, we're going to do some renovations. It's going to be an inconvenience anyways. How about I give you, and what's the number? What would you give to pay Rav to leave?
So I have a standard policy with my staff in the property management offices. For every $100 a tenant is under market rent, on the spot, you have permission to offer them $3,000 to $4,000 to leave.
Stop it.
Yeah, absolutely. I just paid a tenant 2 weeks ago $22,000 to leave a property in Aurelia.
Andrew.
Do the math. Right?
Yeah, this is the math. So you're saying, so I love that. So it's undervalued. You can get $1,500 a month rent with a little bit of lipstick. And right now they're only paying $1,000 rent. So that's $500 times, you said what? 2,000 to 3,000?
3,000 to 4,000.
So you're going to pay me 15 to 20 grand, Rav, to leave that apartment building in Aurelia. And I'm gone, you fix it up, you bring the new person in, because we know there's a demand for rental these days. Vacancy keeps dropping. And it's a win-win because now you've increased that operating income, divide it by the cap rate, you've just exploded the value.
Yeah, so the math I do for Kingston mostly is for cap rate. That might change a little bit with the interest rate environment. But if you take $100, 12 months, it's $1,200. I divide it by 10% or 1.1. So I'm going to take off the allowances for higher property management fees and a higher vacancy rate, it doesn't cost me more to fix a sink if the tenant pays $1,000 compared to $1,500. So I take my $1,200, I take off 10%, then I divide that by 0.04 for a 4 cap rate. It's like $27,000
that you just increased.
So why wouldn't I give someone $3,000 or $4,000 to leave? Even at the $3,000 or $4,000, it's only like a couple of years to get the money back, let alone the value increase. Now, my appetite to pay somebody 20 grand in say year 1 of the building might be a lot higher than say year 7, because I'm trying to get the highest value possible to get all the investors' money out.
Andrew, it's perfect. You know what? We're going to take a quick break. When we come back, now we're going to talk about what's in it for Rav. If Rav wants to partner with Andrew, invest with Andrew, let's go through those 4 questions that I always ask. The return, when do I get it? Minimum amount needed, and what is the risk? We're talking to my friend Andrew Brennan. He is blowing my mind with the way he is investing in apartment buildings. Don't go anywhere. We'll be right back.
Are you looking to buy an investment property and you're not sure where to source the down payment from? You may be sitting on it. Many investors find the first source of their down payment for their first investment property from the equity in their current home. The number one objection I hear is, well, then my monthly payment is going to go up. A couple things. What if you restructured that debt to make sure that you weren't paying out of pocket for that additional cost? Or what if you were buying a quality cash flow property that produced enough rental income to pay for that additional borrowing costs? Now, this may not be for everybody, but this is an exceptional strategy that works really well for getting people into that first property, that first investment. If you're looking for a customized solution that would work for you, reach out to myself and the Kyle Ford Mortgage team.
You've always dreamed of having rental income, but buying a rental property? Well, that's a tall order. Capitalize on the space in your home instead. Renovate and rent out that space with ease with LegalSecondSuites.com and the team at Wise Construction Group. With LegalSecondSuites.com, our talented team of BCIN designers, engineers, carpenters, and tradespeople can transform that unused space into a beautiful, legal, and safe rental unit. We're empowering the everyday homeowner to become an extraordinary landlord. Get more out of your home. Visit LegalSecondSuites.com for more information.
Kaz Cavellos here, founder of First Access Condos, and I'm on Everyday Investor to tell you why now is the best time to get into the real estate market. CIBC just came out with a great article saying that the Bank of Canada is going to stop interest rate hikes. That means, based on cycles of the past 15 years, they'll start to come down sooner than later. Don't get caught on the sidelines. Buy real estate now. Invest in your future. FirstAccessCondos.com. Register. Mention Everyday Investor, and I'll be glad to explain it to you.
Hey, it's Rav. Welcome back to Everyday Investor. I'm talking to my friend Andrew Brennan. We're talking about how we can make money partnering with Andrew, investing in apartment buildings. Andrew, before break, it was just crazy. You were talking about really cash for keys. Most people I know, they find undervalued, undermanaged, properties, and then they do whatever they do to it, and they increase the rent. But you're saying sometimes you buy beautiful properties and just offer what you called cash for keys. You give cash to somebody, they give you the keys, we're done. Now you can increase rent to as whatever you want to a brand new tenant. But there was something else that you were saying you were doing.
Yeah, well, sometimes we'll just actually compensate a tenant for taking a higher rental amount. So you might have a tenant that needs a new car or has got some debt, credit card debt they want to discharge. And again, going back to what I said, we're offering something for a higher rent increase. So we're offering a lump sum payment. We technically terminate their current lease with the proper paperwork. And we sign them a new lease at a newer rate, but often we will give them compensation. The gentleman got $4,000 to take a rent increase.
That's great, man. I really, really love it. Okay, so Rav invests with Andrew. What's typical? Because you've been doing this for a long time.
Yeah.
So what's kind of typical on average return on investment for RAV?
So we target anywhere from 15% minimum on average per year. So obviously that's an average. So equity growth at disposal or refinance would be our minimum target. I used to say that I don't get out of bed unless it makes 30% per year, just in humor, right? Because it's a very memorable. So we look to have 15% for the investor. And then usually, because we're getting a little bit larger, we have to have accredited investors.
So what is minimum investment that's needed?
So the minimum investment is usually $150,000. It depends on the project, but that's usually the lowest we will go. So, and that might be $150,000, might be a 10% ownership of a project. It could be 20, depending on the building size and the numbers to get into a particular building.
Okay. But you don't get involved in anything unless your projected returns are about 30%, and then you split that with an investor like RAV, 15%, so on and so forth. And that's kind of your projection at a minimum. How is that paid out to RAV?
So usually what we do is we do cash flow, after a year or so, once the building normalizes, and then we've got your traditional mortgage pay down and equity growth. And equity growth is usually a good chunk of it, doing the cash for keys project, right? And then we look to refinance in roughly about 3 years. Often we do our projections based on a 5-year timeline that the money's invested, but that's a worst case scenario. But we try and go a little bit faster to the bank, right?
So when you refinance and you take out a big chunk, does that big chunk get paid back out to the investors?
Yes, first, yes. And if there was additional money above the investor's original input, then it would be distributed based on percentage of ownership of the corporation owning the building.
Okay. So I can get a big chunk of that 150 back, but I'm still continuing to make some income until one day if ever you sell the building, yeah? Or are we done? Like once I'm paid out, that contract's done?
No, once we give you back your money in that, you still maintain the same percentage of the building that you had.
Wow, that's great, man. That's a great vehicle. So obviously, the government has some qualifications. You need to be a credited investor or whatever the case is. But minimum 150, get paid out. It's everlasting. If we ever sell the building, then you'll split that with the investors as well, based on what percentage they have ownership of. With something like this, Andrew, as objective as you can be, what is the downside? Like, what's the risk? In this, I know these things are pretty recession-proof. I mean, somebody's got to live somewhere. But that being said, what would you say objectively is downside?
Well, I think most people right now would think the biggest downside is interest rates. Okay. And what I like about the cash for keys strategy is, regardless if cap rates don't go anywhere, or even if they go up, which actually means the building value goes down, because we're doing cash for keys, there's nothing from stopping us to get to the market rents. And so we can get to the market rents and still drive our building value up in an environment where building values are going down, because it's going back all to the rental income, the operating expenses for the NOI. So it does allow us to greatly reduce the risk. Sometimes there's some extra costs with renovations and stuff like that, but we usually have that good idea of that up front, and that money is either planned for or raised initially. So sometimes, if I want to keep the ROI up for investors, I'd say renovations are 250. I may do private funds for the 250, right? Through someone's RSP, especially sometimes we defer the interest, and it keeps the ROI up. So there's a lot of strategies to keep the returns good, even in an economy or a market that becomes downturning.
So if somebody's not an accredited investor, but they have money or RSPs, they can lend you money and they don't have to be accredited.
Correct.
Yeah. So you're working with all types. No, that's great. Yeah. That's great, Andrew. And so let's talk a little bit about geography. So, because you live where?
I live in Wasaga Beach, just outside of Barrie.
Okay, so you live in Wasaga Beach, but you have how many doors in Kingston?
Either the property management office I have in Kingston, we manage one 16-unit building for Quinton D'Souza, who's a good partner of ours, and I think they're managing about 500 out of that office. So between Belleville and Kingston.
So you have 500 doors between Belleville and Kingston,
Yeah.
which I'm very familiar with. But so why do you choose that area as opposed to Windsor, Sudbury, Kapuskasing? Like, what took you to Kingston?
There's a couple reasons. The actual availability of product in Kingston is very good. There are something like 250 buildings in Kingston that have, say, 10 units or more. And there's like a lot of cities, larger cities, don't have that type of building volume. Like if you take, for example, Brampton, probably 3 or 4 times the size of Kingston on the census. But I don't think they have that many buildings, at least not when I grew up there, right? The other thing is, as GTA became more expensive and people get older, it's just a matter of time before they move out of the GTA. So I actually started most of my investing in the Wasaga Midland area, and I just knew that people were going to come to either Barrie or outside of Barrie. And though that market's kind of ran up and it had its rent increase, and now I've seen the 401 corridor going east is getting the rent increases, which brings the building value increases. So able to raise the rents, drive the buildings up, and actually be able to buy buildings.
Okay, very strategic. It's not because it was the former capital city of Canada, or because it's one of the top retirement homes in Canada, or because they have a lot of penitentiaries, or because yours truly was born and raised there. It's because it just makes sense. It makes sense that there's a lot of product that you can buy, and like I say, it's people are scrambling to find tenancy, so they're willing to pay as long as they have a good product. No, that's really great. That's great. Yeah. So what's next? Like, what between now and 5 years from now, is this the niche, Andrew, or is there other things you're exploring?
No, I think this is pretty much the niche. Maybe a little bit of smaller construction. I just picked up a piece of land in Napanee that came with an under market rent building with another building already approved, and that only uses up half the land. So it's kind of hard to say no to that, right? The current building's 5 years old, excellent condition, right?
No, but, I love it. I mean, that's such a great, Kingston, Amherstvyou, Napanee, all the way to Belleville. I mean, there's Trenton. I mean, there's a lot of great places, in there. Andrew, thank you so much. And so, if people just want to, reach out to you, your information's on the screen. You don't mind any of the viewers to be able to say, hey, tell me how I can enjoy, projected returns of 15-20% annualized. You don't mind a phone call, email?
Of course not.
Okay. Well, thank you, my friend. We'll have to have you on again and see where you're at. But like I said, we've talked a couple times, but more importantly, I read the book. People, mutual friends like Quentin and others speak very highly of you. And so thank you for doing what you're doing, and meaning, getting returns for investors. I mean, I think it's really important. There's a lot of things out there that are not necessarily, and I'm not saying intentionally, but they're not on the up and up. And you could easily take people's money and give them a return of 7-8%. They'd be happy. But you're doing an equity play. You're not a debt play. You're an equity play where you're giving them a percentage of the returns that you make. Whatever you make, generally speaking, they're making 50%. So I think that's very cool. Thank you so much for being on the show.
It was my pleasure. Thank you.
And thank you guys for watching. Without you, we would not have a show. Make sure you tune in next week, same place, same time. If you want to watch the show again, go to everydayinvestor.com, click on episodes. You can do that at your own leisure, or any of the other episodes that we've done. That's it for now. Honey, I love you. I'll be home soon. Bye, everyone.